If you want to ensure your future, investing is the best option, but investing is riskier than saving money. Therefore, you need concern about many factors before investing. So, in this video, we are going to talk about the factors that you need aware of before investing. First, let us see what is investing. Investing involves committing money in order to earn a financial return. This means that you invest money to make money and achieve your financial goals. If you want to keep your money with you without investing, you'd never have more money than what you've put away yourself. There are many options that you can choose in investing your money, such as stocks, bonds, ETFs, mutual funds, cash equivalents, real estate, REITs, and commodities. Now we know you're eager to learn the investing basics. But before starting investing, you have to consider many factors. Number 1. Do you have a lot of credit card debt? If your answer is yes, you are probably not ready to invest just yet. First, do all you can to pay off the debt, because no investment will consistently beat the 14% or more annual percentage rate you're likely paying on a credit card. Number 2. Do you have an emergency fund? Any financial advisor will tell you that if the unimaginable happens, you should have between 6 months and a year's worth of total living expenditures in cash or in a savings account. So now we will give you some investing tips to follow. Start investing, even a little at a time. You'll definitely want to invest once you've saved some money. Inflation will nearly always outstrip the rate of interest available on a savings account. You'll basically be saving and losing money simultaneously. As a result, you should begin investing as soon as possible. Know what you're investing for. How you invest is determined by the purpose of your investment. You could be putting money aside to assist your 14-year-old in paying for her forthcoming university tuition. You might wish to put money down now so that you can live well when you retire in 30 years or so. Each of these investments has a very different time horizon, because you'll need some of them sooner rather than later. Those with shorter investment horizons should be more cautious. Riskier investments are available to those who have money they won't need for a long time. Understand the risk you are taking. You must first determine your own risk tolerance before determining where to invest. This is a sophisticated way of describing how much money you can afford to lose on your investment. You have an extremely low risk tolerance if you need money for next month's rent. Your risk tolerance is extremely high if your life would be unaffected in any way if, instead of investing money, you set it on fire. Your risk tolerance is sometimes determined by your time horizon. Savings accounts are often seen as low-risk investments. They're ideal for storing your emergency fund, rainy day funds, or this month's rent. Investing is better for the money you won't need in the near future, such as retirement savings or a fund for your child's university education. Diversify your investments. Diversify your investments rather than focusing on a single stock that you believe will do well. This way, even if one element of your investment collapses, you won't lose everything. Diversification is an investment strategy that lowers your portfolio's risk and helps you get more stable returns. Diversification can be achieved by investing your money across different asset classes such as shares, property, bonds, and private equity. Invest for the long term. Invest for the long term if you can. Many studies indicate that investors who keep equities for more than 10 years are rewarded with better returns than more than compensate for short-term risks. That isn't to imply that the current trend will continue or that the danger will ever be completely eradicated. Risk never goes away, but it does get more manageable with age. Watch out for high fees. Fees are money that you put into someone else's pocket instead of your own. Fees will be paid regardless of how you invest. High fees should be avoided at all costs. They'll have a huge negative impact on your profits. You should think about the value you're getting in exchange for the fees you're paying. Consider how much time you can put into investing. Managing your investments can take a little time or a long time. Before you invest $1, consider how much time you can put into managing your investments. Make an investing plan and stick to it. One of the most common causes of low returns is that many investors sell at an unsuitable time. They frequently make judgments based on previous performance. They examine what has been doing successfully or badly recently. Many investors choose to purchase items that have increased in value while selling items that have decreased in value. Rather, you should devise a strategy that you believe will assist you in achieving your objectives within the time frame you have available. Don't give up on investing because of poor results. Stick to your strategy instead of buying or selling based on what you think may happen in the near future. If you are ready to put all these beginner investing tips, you can surely be a successful investor. We are ready to guide you through your investing journey in this video series. So, subscribe to our channel and hit the bell icon and stay with us.